Hello, good morning everyone. Welcome to our budget session event where we will delve into the significant announcement of the interim budget 2024. Well, I am Swati Sinha, hereby representing Sailotech, which is an application service provider offering solutions for e-invoicing and GST filing tailored for Indian localization. This event is made possible in collaboration with Darda Advisors. They are our knowledge partner and they are known for delivering client specific tax solutions across India. They are providing expert strategies and solving tax and regulatory issues. So, everyone, just buckle up for an insightful journey into the budget session. As all of you know, like the Finance Minister Nirmala Sitharaman presented her sixth budget yesterday. She prioritized on youth and women empowerment, maintaining fiscal consolidation and continuity, having a fiscal deficit target set at 5.1% of GDP. So it's quite evident that this budget holds crucial implications for various sectors. So yeah, now allow me to introduce our esteemed speaker for today's session. They both are renowned experts in their respective domains. So, firstly, we have Mr. Vinit Sumandarda, an expert in indirect taxes, and also he is the co-founder and managing partner of Darda Advisors LLP, with an impressive background of a qualified chartered accountant, company secretary, and management accountant. He brings over 20 years of rich experience in the field of tax and regulatory services. Now let's turn our attention to Mr. Aditya. He is a direct tax expert and he will be sharing insights on the other side of the fiscal spectrum. Thanks both of you for joining and please guide us through the intricate world of tax analysis and insights.
Thanks, Swati. Thank you so much for allowing the platform Sailotech to provide our insights on the budget. Obviously, this budget is an interim budget for 2024, and the government is confident that they will come with the complete full budget in the month of July. Looking to that, this budget is completely for a Viksit Bharat, a developed country, India, by 2047. Looking to that, if you see all the aspects from the digital infra, from the development, has been concentrated towards that. So that's why the goal is to have Sabka Saath, Sabka Vishwas, Sabka Vikas, and now Sabka Prayas. Being an Amrit Kal, everyone has to commit, at least for next 5 years, to contribute to the society, the country, from all perspectives. And the government has taken the people-centric inclusive development. Looking to the infrastructure development, it may be the physical, we can see on road, rail, air, digital, like UPI for the transfer of amount directly to the beneficiaries, and social infrastructure and inclusivity. They have given the GST law around 6 years back, which we can see it's moving and giving the widening of tax base across India. GIFT IFSC, which is in the Gujarat, which is even allowing now for listing of Indian company on the global exchange. That's again a major benefit which going to come to all the people. There's a proactive inflation management which government is doing to ensure that India is growing towards being a developed country. The focus area starting from the poor people, we can see the eradication of poverty, which we have seen in last 3 years further after the COVID, empowering the youth by the skill development, by giving the Mudra Yojana funding to all the people from the job seeker to the job giver. They want people to be there. On farmers, they're giving direct subsidies. They're concentrating that even the fertilizers is coated, neem coated, so that everything is controlled and regulated and reached to every individual. On Nari Shakti, they are giving the Mudra Yojana loans, they are giving the enrollment in higher education. Even the NEP is concentrating on the inclusivity and equality for all the genders. Coming to the Amrit Kal, they have made their own strategy. And if you see, the word which came first time is GDP, the governance, development, and performance. We always see the GDP as a gross domestic product, but looking the way the government is concentrating They want to see the all inclusivity and they accordingly define the new language for GDP. The first strategy is the sustainable development. It means we want India to be net zero by 2070. For that, they are concentrating on the renewable energy. Even we can see from investment side, they brought multiple PLIs in last 1.5 years for solar sector, for EV sector, for electrical sectors to ensure that India have the more productions, less dependency on the overseas supply chain, and provide the right infrastructure to all people. Even for a wind energy, they have target to a 1 gigawatt plant. Recently, last week, they brought the coal gasification scheme to ensure that we no need to import natural gases that can be done within India. There is a phased manufacturing and blending of the CNG, PNG. Even they are giving the financial assistance for bringing the machinery to have a biomass production. We can see EV adoption. They want across India all the public buses to be EV, and even see the even municipalities and all are giving the multiple orders across India, and even there are schemes for the two wheelers and other EVV where they can reduce the cost of the vehicle for end customer. And if we see the infra development, they are working on the roads, rails, airways, port, shipping, even the PM Gati Shakti program, with ensuring that we have a multi-modal transport and accordingly connectivity at its last mile. The strategy for Amrit Call again is third part is inclusive development, not only from the capital intensive part, but also from the health, also from the housing for everyone, which we have seen even they are giving the PM housing yojana. Already 3 crore houses have been constructed, and the next 3 year they have planned to make 2 crore more houses. In tourism, we have seen the way the G20 has been initiated at 60 plus location. The multiple meetings happen. They want India to be the meetings and conference hub. We can see the way the Delhi, we have the largest ever the conference area has been developed. In Goa also we can see development of such area. So from all perspective, they want involvement of state, center, the tourism agency by subsidies to states and other people, so that India is a tourism hub. Even we recently seen even Maldives have envy towards Lakshadweep when our PM has shared the 3 4 pictures of Lakshadweep, and it has created a massive involvement of people to ensure that people move to the Indian tourism instead of going to the global movement part. And if you see for a capital contribution, already they have told we have invested multiple lakhs crores till now in last 4 years. And from next year, they are giving the 11.1% further jump. And the amount is everything in the 111, 11 lakh, 11,000, 111 crore. All these 11 lakh plus 1,000 crores they are giving for next year, which is around 3.4% of GDP. Again, they are progressing on the agriculture and food processing, and you can see in the 2021 the scheme called PLI for food products, which came from the Ministry of Food Processing Industry. Even we can see the ODOP, the one district, one product. From all the scheme, they are pushing that the India should market their product and it should reach to every place. It should not be concentrated in particular district or particular state. Everyone should be aware, whether from Indian customers or a global customer, what all we can do. And you can recently see the way in last 3 years, even the toys, we used to have 80% import from China, which are not of a good quality. Now, if we see the way it is moved, it is now 70% is make in India. And the way we are looking, the government bringing one more scheme for toys also, so to ensure that India is not only a domestic manufacturing per se, it can also go for export. So that India is going to be toy hub. Even they plan to bring PLI for your headgears, For other products also, they are bringing for the electronics per se furthermore, apart from the current schemes which are already running and having the allocation of budget more than a lakh crore. Now I will request my colleague Aditya to share the insight. Obviously, being an interim budget, the limitation are there to share, and they are very confident that they will bring the all schemes, all the aspects, all announcement in the full budget which will come in July. Now I request Aditya to take it forward on direct tax proposal, and then I will share my insights on the certain limited indirect tax proposal which came in this interim budget. Over to you, Aditya.
Thanks. Thank you, Vinith, for this brief update on the policies and the economic parameters. Uh, yes, you're right. So this is an interim budget, a vote on account, and the FM made it clear even before it that not to expect any significant changes in the tax because that was also, as he clarified, out of the scope and would not be doing justice to the purpose for which the budget is being presented, since the country will be going in elections. So on those expected lines, this year's budget has been one of those years where we didn't have to burn the midnight oil. What's the budget? Hardly there was anything much to read, but still, it's good to be updated. And as tax professionals, we try and see if the fine print presents any surprises many times as it has in past. So I'll quickly take you through the few changes. So first of all, the tax rates remain unchanged. They continue to be the same. That is, the new tax regime for the individuals continue as it is. Up to 7 lakhs, you have no taxes, and that continues to be the default tax regime. So if an individual wants to opt for the earlier regimes where you had multiple tax rates and with the deductions with exemptions, then the individual will continue to actively opt for it before filing a return. Otherwise, by default, he will be migrated to new tax regime. Now, then the LLP and the partnerships continue to be taxed at the base rate of 30%. Corporates have the option of going for the lower tax regime of 22%, which covers by and far the most of the corporates, while they have to give up the deductions, if at all they were claiming, which are anyways on their way out, being phased out. There was another category of newly set up manufacturing units, eligible manufacturing units, which were given the leeway of opting for a lower corporate tax regime of 15%. Um, this has been one surprise where there's been no extension. So the condition was one of the conditions. The key condition was that the unit commences manufacture of production before or the 1st of April 2024. That is on or before the 31st this March 2024, which is like 2 months from now. So if the unit is not able to commence by that time, the lower rate of 15% is not an option that will be available to that unit. So these was on the corporate, on the tax rates, they basically remain the same. Uh, then there have been certain administrative announcements, proposals rather, to extend certain holidays, certain exemptions, just to ensure that there is some certainty and continuity in the policy making, which this government has been doing in the past few years. Those exemptions are in the nature of in exemptions on in the nature of tax holidays being provided on income earned by the sovereign wealth funds, the pension funds from the investments in the infrastructure sector, from the units which are set up in IFSC GIFT City that Vinith was referring to in Gujarat. The income that is derived by such units by way of royalty, by way of lease income from lease income from the leasing of aircraft or the ship, by way of an investment income of the offshore banking unit in IFSC. So these all were exempt for those units which were set up by 31st of March 2024. That date has got extended by 1 more year. So now units set up in these IFSCs in eligible businesses will continue to be claiming exemption if they are set up by 31st of March 2025. Then the tax holiday on the startups, which was claimed under 80 IAC, has also got extended by a year. So startups which are set up and commencing business by 31st March 2025 will continue to avail the tax holiday of 100% exemption or deduction on their income on their income for the 3 out of the 10 first 10 years block, with the eligibility criteria remaining the same. So next slide, please. Then the TCS provisions, which had seen a lot of flip flops last year. So it was introduced, TCS was introduced on LRS in the last year's Finance Act in the budget. And then there was circular. This was supposed to be introduced by 1st of July. There were a lot of public representations on the provisions. A circular was issued with certain clarifications. From October, the instructions were laid out on the TCS directions on overseas tour, on LRS payments. So basically, uh, all these circulars, all the instructions in the circular have been now been proposed to be codified in the act. So there's nothing new that is brought in, just that the instructions, the in the circular has been codified. So in amount in excess of 7 lakhs would now be subject to 20% of TCS on the remittances, other than certain purposes like medical and education. And that is now that is now proposed to be enacted in section 206C 1G. Then coming to the ease of doing business index. So India has been making gradual improvement on the index over the past many years. Now, the last was 62 in 2019. It is expected that the World Bank would release another benchmark for testing the ease of doing business in various countries. They are doing away with EODB, but they are bringing in something else in comparison to this, and in line with the government's approach to continue making it easier and making life more business friendly for entrepreneurs. The government has now sought to withdraw certain old small tax demands which are lying outstanding for them. So the finance minister in her speech touched upon this, saying various petty, non-verified, non-reconciled, disputed direct tax demands, which date as long as 1962, and those demands which are up to 25,000 for up to financial year 2020 to 2009-10, and up to 10,000 from 2010-11 to 14-15. The CBDT will give up pursuing those demands and save the unnecessary worry that a taxpayer has to go through, because many such cases are dating to way back where the papers to justify or to defend are not available. Even for the department, it's an hassle. The documents may not be there at times, So this is a welcome relief for many who are facing such issues. While this has been one, the other initiative of the government, which has been to initiate faceless uh, faceless assessments, faceless communication with the revenue, especially on the direct tax side. They have rolled out the assessments completely online, but still we find certain interactions, certain assessments having to be done offline. One of them is a transfer pricing assessment, then the DRP assessment, even the ITA tribunal appeal proceedings. They've all been in the bucket list of the government to be made online as faceless, like the way we are doing assessments. However, there have been no instructions issued, and the sunset clause, the deadline for issuing instructions for implementing these was March 2024, which obviously there's nothing moved. So the scheme would be rendered futile if the date goes by. So the date has been extended for one more year till 31st of March 2025 for the government to issue directions for implementing faceless scheme of conducting proceedings for the TP assessment, DRP, and the ITAT. So these were the proposals made, and while some have been given a miss, even notwithstanding this is being a interim budget, some of them has come as a welcome relief, like the withdrawal of all small tax demands. Now, there are certain controversies uh, which have built upon, which have you know, which have been doing the rounds of discussion in various professional circles. So, although I would say, although the budget didn't have much for the tax proposal, still there are certain views this side or that side on these propositions that the FM made. So, Vinit, how do you want to continue? Do you want to touch upon your IDT proposal first, and then we come back and discuss those trivias that you are going through in this direct tax proposal?
Yeah, so Aditya, first we will discuss the indirect tax proposal, then we will take the Q&A
Right. Okay,
together for DT and IDT.
fine. Yeah. So this,
Thanks, Aditya, for sharing your insights on the DT proposal. Obviously, the looking to interim budget, not so much came, but yes, the relief which is given under income tax is a major part. Now we come to what indirect tax proposal. You were expecting there will be nothing, but still, major two aspects have been shifted under mood under the GST law, and also some relief given beyond budget also on the same day. So before we come to the IDT proposal, yes, even the key aspect shared by Honorable Finance Minister during this her speech on GST. So there was a survey done by one of the top consulting firm, which is not mentioned by Honorable Finance Minister, which mentioned that 94% of the industry leader view that transition to GST are largely positive as on date, and also it helped around 80% agree that it has led to supply chain optimization, elimination of tax arbitrage and octroi in disbanding of checkposts at state and city boundaries. Further, the average gross collection of GST revenue reached to 1.66 lakh crore, which is a good amount, and the way it looks, the government is expecting in next 2 3 years to reach to around 3 lakh crore, such a positive upward number which they are looking for. Also, based on the speech of Honorable Ma'am, GST reduced the compliance burden on trade and industry. Obviously, yes, but yes, still the industry looking for further streamline majorly on the input tax credit aspect. And if you see from a customs, yes, even we have seen a major breakthrough in customs in reducing the timing, which is a major aspect which anyone will see in supply chain. For India, have the more hours it takes if we compare to China or US or European countries. So based on the estimate, import release time of the consignment declined by 40% to 71 hours at ICD, Inland Container Depot, by 28% to 44 hours at air cargo terminals, and by 27% to 85 hours at seaports. And the visa is the Turant Yojana, the AEO, direct port delivery, direct port entry, self-sealing of goods. These all initiatives are helping to reduce the end-to-end supply chain timing in all the consignments. Now come to the GST updates. The major change which has been introduced in the finance bill is on the ISD, Input Service Distributor. If you see the earlier GST Council minutes, they have given assurance and they clarified ISD is optional. It is not mandatory. You can cross charge or having ISD, it's purely a discretion of the taxpayer. Now, after this amendment, where the changed definition of ISD under Section 261 and also the relevant provision Section 20 under CGST Act, now the ISD has been made mandatory. Every taxpayer who have an office which receives any tax invoices. It may be the domestic invoices or it may be under RCM. All these invoices which they're receiving for themselves or on behalf of distinct person. So in GST distinct person, every branch is a distinct person and have a separate tax number. It means both has to receiving at common place any out input services from domestic market or import of service or a domestic services where RCM is applicable. In both the cases, they have to distribute it to other distinct person. So even they have given the procedure, CGST has to go to CGST, IGST has to go IGST, and also SGST has to go SGST. But how much it will be allocated, what will be the percentage, what will be the formula, earlier used to be based on the previous year turnover or previous quarter turnover. Now they will give the new procedure under the rules. So we can expect after this budget is passed by Honorable President of India, the rules will be issued on process of allocation of credit from ISD to other distinct person. Even there will be separate document issuance. Already in the law is there how to ISD has to distribute the credit. But it may again change once we see the rules comes into existence. Then only we can expect this to come in order. And we need to include everything: your reverse charge invoices, your output forward charge input invoices, all has to be included when you are distributing it. And the first time in the definition, they specifically included the definition and the coverage of distinct person. Obviously, it used to be there to other branches, but now they specifically include distinct person there. So, looking at provision, which has now made ISD mandatory, now mostly all suppliers who have multiple branches, who were head office or corporate office having no business or little business and having the other location having the multi business, or in the same location you have a corporate office and the factory or a unit, but both having a two separate registration, then you need to take corporate office as ISD, accumulate all credit on month-on-month basis for RCM, for direct charge input services, and then you need to allocate to all other distinct person, whether it is directly related to the particular distinct person or on the common formula basis. So this change is an additional compliance burden for all taxpayers, from taking registration, from filing returns, for reconciling the credit which pertains to the specific unit or common to all the units that is taken care. Even the formula which may come now, because whatever previous formula has been set aside, has been to be bring with new formula, which may come under the rules, has to be looked into it. The other change which happened in under new section has been brought, which is section 122A. And under this section, whatever procedure you have to follow as a manufacturer, which is given under section 148, only for manufacturer for specified products, you will have an additional penalty. We have mentioned the relevant all notification issued till date under section 148. But in our view, it is mostly talking about the tobacco and pan masala products for the manufacturing aspect to be looked into it. You can see all these are the notifications issued under section 148 in addition to other sections. So now new section is called 122A, a penalty for failure to register certain machines used in manufacture of goods as per special procedure. And special procedure is specifically mentioned in section 148. So what it says, whatever machinery coming in your factory, you need to register with your adjudicating authority. If you are not registering, they will impose penalty of 1 lakh rupees for every machine. Please note, it's per machine. They will impose 1 lakh rupees every machine. It is in addition to any other penalty which may be imposed under 73, 74 or any other section to an taxpayer. Second, in addition to penalty, they have also have additional power to seize the machinery and confiscate it. It was purely they given the multiple authority, multiple power to regulate that particular industry to ensure that whichever machine coming into factory for production, it is registered with the government. If it is not registered, pay 1 lakh rupee per machine. If you are not paying 1 lakh rupees, then it will be seized. So your mitigation to get relief of this penalty is either pay it or register it within 3 days of penalty order. Else you need to pay it. So this came into the finance bill, and beyond finance bill, on the same day they announced that the remission of state and central tax and levies, which is called ROSCTL scheme, the post-export scheme for manufacturers of apparels and garments, has been extended from 31st March 24 to 31st March 20. It's a big relief for textile industry, which is already facing through the severe recession and underproduction and a good strong competition from Vietnam and Bangladesh. So obviously it will give you the big relief that for next 2 years still the post-export benefit continues. And the goods which are not covered under this scheme are in road tab. Road tab is still in existence and it may be further extended based on the expiry date of the scheme. Further, there is one more relief given, which is again beyond finance bill, by custom notification on mobiles. So currently, India does not have the back-end supply chain for the mobiles. In that case, we are importing and there is a heavy duty on all these parts. The government has reduced the duty on the parts like battery cover, front cover, middle cover, main lens, back cover, GSM antenna, PU case sealing, gasket, SIM sockets, and given big relief. We can expect around up to 3% reduction in mobile cost to the consumer. And that's going to be giving big relief to the end consumer. One thing which I would like to put here, which is the last part of our IDT proposals, is on in the last budget on the mover scheme, which is the bonded manufacturing warehouse scheme. The section 65 was introduced, which has completely demoralized industry players to opt the scheme or not, because it is imposing IGST and competence cess on each procurement. As on date, this provision is not yet notified, but our expectation was the way the industry has given representation, that provision should have been removed from the law itself. So the scheme brought in to ensure that India become a manufacturing hub. Because it's an easier process to set up and also to be compliant and to ensure that India can be an exporter for other countries too. So that all on the proposals from DT and IDT. Now we will move to the Q&A part of the scheme. So Aditya, before we take, Aditya, can you hear me?
Yeah, I can hear you. Yeah.
So Aditya, before I take questions which came here, I have two queries with you. The first is on the lower rate deduction, lower income tax rate. There is a specific provision which allows manufacturer to have a relief on that part. So whether such provision or a startup provision, both has been extended or only the startup relevant tax provision has been extended. Can you please put an light on the both aspect and clarify on that?
So I wish I could say yes to both, but I any new manufacturing unit is that's
Your voice is breaking.
okay. Am I audible now?
A little bit issue is there. You can continue, Aditya.
I'll speak a bit loud. So, let me know. Not, so I would say I wish I could say yes to both, but it is not the case. The newly set up manufacturing units, which have the duty of 15% of tax rate, that the deadline was
Your
31st.
voice is not audible, Aditya.
Is it audible now?
Now better, Aditya.
Okay, so I'll just stop the video. I don't know what. Yes, the answer is no, Vinit. These set up units will still have to be set up and commence production before 31st, on or before 31st of March 2024. That date has not yet been extended. So any newly set up units which starts their production after the 31st of March 2024 will not be eligible as of now. The provision state will not be eligible for the opting for a lower 15% corporate income tax rate. That provisions for extension of this incentive is not come. But on the other hand, the startup which you are saying, startup eligible startups which commence their businesses before 2025, now 25, earlier 24, for still 1 year, can still claim tax holiday on their. Uh, now, these two do not. Uh, these two are exclusive because one of the conditions when you opt for a lower tax regime under 15% for daily manufacturing setup is that you give up all the deductions and exemptions, except for a few like 80 JJAA, that's on the employment.
Your voice is breaking, Aditya.
Am I audible now?
Yeah, audible now.
Saying, see, for startups, while the period has been extended for newly set up startups, the newly manufacturing units were not that fortunate. So, and also one of the conditions under 115 KBE for the newly set up manufacturing unit, you give up all the deductions. And this is under Chapter 6A, except for one or two, which is like the ATJJAA. So basically, the tax holiday under for startups which come under Chapter 6A, ATISC, you cannot claim that if you qualify to be a newly manufacturing unit also. Both do not work. They are mutually exclusive. You can't have both. And even otherwise, the dates are not been extended for manufacturing units. That's and or if you don't know as of now, the finance minister has not commented on that. If it's a miss or a purposeful uh, ignorance of that, we're not sure of that.
Maybe I think they don't want to extend the benefit. Aditya, I have one more question.
There
In
was
the speech they have mentioned, Aditya, can you hear me?
hey, you.
There's one more question I have from direct tax part. There's a withdrawal of small amount direct tax demands for some specific assessments here. So whether that will include TDS also, or will it be only per year, or it will be the in total amount? And why it is not came in the finance bill? It should mention it is mentioned in the speech, but not in the finance bill.
Okay, so this is a question that even I was thinking initially, the why was it not financially? I guess,
Your voice is breaking, Aditya.
am I audible now? Hello?
Audible, but in between your voice is breaking.
Okay, so let me try to the mic. I'm saying that, see, the question of one on the, what was the first question? Sorry, can you repeat?
Yeah, the
on the
first question was, is a lower tax demand relief given for
TDS.
relevant financial years, whether it will include TDS
TDS,
and whether it will be the in total amount per year or it will be in total amount.
the TDS will be included because the tax demand is considered to include everything that comes within the Income Tax Act. So the TDS forms part of the same statute, and you have corresponding. See, you can take reliance on the provisions under MAT and Section 48(2), where there is a principal tax. TDS will be included under this, and whether it will be per year or block, I think the way I did it will be per year and not for the blocks is given because uh, then we hardly left with any amount, and there are a lot of years that is covered. So I suppose it will be per year, and that's how you see the demand. When you log into your portal and see the outstanding demand, that's how you see. I think that's what would be the starting point for them to see how much is the demand shown there, and whether it's for per year, less than 25K or less than 20K, as the case may be. So yes, the answer to my mind should be per year, but we will await a CBD clarification on this. We are expecting more, all the more because this is not been a part of the finance bill. And I guess because the Section 119 empowers the CBDT to take measures for administrative convenience and for the administrative operation of the tax machinery. I think it may be because under 119 it's taking powers and hence the finance speech included it and it did not felt it necessary to include in the finance bill. Nevertheless, we are expecting CBDT clarification on this at press release uh, confirming all these points.
Fine, fine. And there's one more query from DKDD from direct tax. Is there any interest charged on tax amount for
Uh,
the duration of tax holiday?
Interest charge on tax amount for duration of tax holiday. I didn't get that for duration of tax holiday in the sense. Didn't get that question. So when you have a tax holiday, that is the question of interest coming on these liabilities. I'm trying to understand that. Is it
Fine.
possible? Is it possible
Uh,
for the speak explain?
I think they only this point they have mentioned. Maybe we can discuss in detail in the separate call on this point with DKDG. Yeah, one more question from our Mr. Jayaraji, who is the director, founder of CIMEI from Bangalore,
Yeah.
on allocation of modified program on development of semiconductor and display manufacturing ecosystem and some solar power. So Jayaraji, good morning. There is no specific mention in the bill or in the budget speech, but there is a already allocation made, which is more than I understand 500 crores. But I will come back to you with the correct number, and I will call you on that scene. Any other question, Aditya?
Uh, this thing, I so whether so ISD was in place even before, and now it is being made mandatory. So is it like so? There could be situations which I understand. So there could be something like a share issue by a company which will be at corporate level, and the services taken for that. This is advocate invoices for in relation to the share issue. Um, that is subject to RCM. So how does the ISG work now for that? Will you be able to do an RCM on the ISG then? How will you do?
So, Aditya, currently what's happening, the normal registration taxpayer, whether
Hmm.
corporate office along with this one, they used to pay under RCM. And if there is no output activity in particular state, then that amount used to be accumulated in that particular corporate office registration. Now in future, and it all depends on cross charge, whether they are able to cross charge or not. based on the turnover and all. I have seen multiple companies are facing that they have multiple lakhs and crores of money sitting idle in the corporate office registration, and they are not able to distribute. Whether they delayed ISD registration or they did not take the registration on that. Now, after this, the corporate office or any other such location has to compulsory take ISD, and the paying under RCM for that registration, they can allocate to a particular distinct person. And in case your case being the share allotment part, it has to be allocated equally to the all the location. And we will able to know the process and proportionate only once the relevant guidelines are issued under rules.
And suppose there is a company is into a group is into power projects. So each location it floats an SPV, and for each location it takes a GST registration. Say for two plants in a particular area, say in the state of Rajasthan, in the area of Jodhpur, they have two solar plants and two SPVs, two GST numbers, because they are two separate companies. Now, one of the companies take a report on feasibility, or you also on the feasibility, but that is being consumed by both, and those are not corporate companies, those are both are SPVs. So does that mean then even that SPV will have to take an ISD now in addition to the ISD taken by the corporate entity?
So here one point is, first, I think power sector is outside the purview of GST from accounting
Correct.
perspective.
Right, so
The
let's say
second
not
point is,
power, let's assume this is construction company.
sorry, because even in construction, the point come here is SPVs are mostly come as a legal entities, which I have
Correct.
seen. I never seen come
Correct,
as a
correct.
branch
Legal
office or like
entity. Yeah, these will be legal entities, right?
If they are coming as a legal entity, they are not a distinct person. They are separate taxpayer as a legal entity. So ABC, DEF are two separate legal entities. They need
Correct,
to take
correct.
separate registration. There will be no requirement from ISD perspective, and they cannot do the transfer of credit to each other as ISD.
Okay, so then this is more relevant for cross charge. There should be cross charge ideally, right?
Yeah, yeah. You can see ISD versus cross charge was a big fight earlier. Even the advanced ruling came in 2018, which is told to
Hmm.
cross charge compulsorily.
Hmm.
Then there are so many clarifications from CBI. Now ISD made mandatory. So now need to look into it how they do it. And they only mention about the input services or RC. They never say your common expenditure per se. Also, you need to do it.
Okay.
Like my employee cost, my HR
Yeah.
cost.
Yes.
Uh,
So, okay, so those are cross charges. What you are referring, common costs.
yes, yes, yes.
Okay. Yeah, I am good. I just wanted to add one more point here on the non-extension for manufacturing companies. So, see, the last year there was another section introduced 115 BAE for cooperative societies in the business of setting up new manufacturing units. So, while earlier the facility was the incentive was available to corporates, the cooperative societies were getting missed out. So, even they were included last year, and this was introduced with Finance Act 2023. Now that there's been no extension beyond the 31st March 2024, this means that the cooperative societies were left only with a year to set up and commence production. So, which was not the case with corporates, which were given more time. So, I think that's one of the another reason why this we were expecting an extension because of the paucity of time. And on same lines like the aircraft leasing, the ship leasing in IFSC has given an extension because the ship leasing framework itself was notified in late 2022 and then updated in 2023, so there wasn't much time. So on that logic, it it sounds sensible that the date has been extended for aircraft and ship leasing units in IFSC, but I fail to understand then why the same yardstick was not used in extending the date for newly set up manufacturing companies. More so when the government was focusing on FDI, first develop India, manufacture in India. So yes, that is a answer that even I am looking for.
Obviously, the expectation was Yeah, we can see all this comes in the relief in July 24 because you still have 1 year time. They
Yeah,
may extend it.
yeah, maybe we'll see. Fingers crossed.
I think with that, I think I will over to Swati, and accordingly, then we can conclude the session. And
Yeah, thank you, Vinit. Thank you for the insightful session. Thank you, Aditya, for giving the insightful session. And yeah, as we are concluding this session, I would like to extend the gratitude to each one of you for the active participation, all the participants. If you have any questions, please drop it in the comment section. We will get back to you on that. And yeah, thank you, Salotech, for organizing such a knowledge sharing event. And special thanks to Vinit and Aditya for enriching our understanding on the budget station like for this year.
thanks, Swati, and thanks everyone for
Thanks,
joining.
Swati. Thanks,
Yeah,
everyone.
thank you,
Thanks,
everyone.
Aditya.
Thanks, everyone. Yeah, thanks.